So we've recently made some changes to the fixed income portion of your portfolio. In the next few minutes, I'm going to discuss the changes that were made, why we made those changes, and how you should be thinking about your portfolio given the current market environment. Stay tuned. So as mentioned by our CEO, Bob Reby, in his client letter that went out to all clients last week, we've recently changed a few allocations to our bond portfolio. The first change that we made was we decreased our allocations to both emerging market debt and U.S. high yield corporate debt. I would say as far as the entire bond portfolio that you own goes, both emerging market debt and U.S. high yield corporate debt, those are the types of bonds that have traditionally the most volatility. They exhibit the most equity-like characteristics of all the bonds that we own, but they've provided a great purpose for us over the last 3 to 5 years in the form of enhanced diversification in your portfolio and total return over that time frame as well. They've performed very well. Now, in terms of what we traded for those decreases in allocations, we've increased our allocation to a sector of the bond market called U.S. aggregate bond. And U.S. aggregate bond is comprised of really high quality and much safer bonds, which includes U.S. treasuries, U.S. agency debt, and really high quality U.S. investment grade corporate debt. Now, I don't think anyone would argue with us when we say that the last decade of stock market returns have been really good to us. As clients of ours, you have benefited tremendously from the last 10 years of the stock market and this historic bull run that we find ourselves in. And that's really the reason what's been driving this change. We are coming upon a time where it makes a lot more sense to think about what's coming ahead versus just assuming that this historic bull market is going to continue as is. And when you think about it that way, you want to prepare yourself, especially for you as our clients. As many of you know, we're a financial planning firm focused on much more than just how the portfolio performs. It's about getting you income and protecting the assets that you've been fortunate enough and worked hard enough to generate over your lifetimes. And because we're a conservative-minded group of folks, the idea is to take a look at the bond portfolio and make sure that it serves its purpose in protecting us from the downside risks that are becoming more and more apparent as this historic bull market goes forward. Now, that is really where our shift from emerging market debt and U.S. high yield debt into the aggregate bond space makes all the sense in the world. The bottom line is that we've shifted your allocation from fixed income investments they're traditionally more volatile and exhibit equity-like returns, and we've exchanged those or traded them for much safer, stable, and high-quality fixed income investments that are meant to protect the portfolio from downside risks as they are becoming more and more apparent.